Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hiding in plain sight within corporate filings. Today we're looking at zSpace Incorporated, a company that has gotten a bit of a wake-up call from the stock market. So zSpace Inc., a company focused on, well, we'll get to what they do in a bit, just filed a Form 8K, which is basically a big flashing neon sign saying something important just happened. And the big news here is that they received a notice from Nasdaq, the stock exchange where their shares trade. Nasdaq has notified zSpace that they are not meeting one of the basic requirements to stay listed. It is like a school report card. If you don't get certain grades, you can't stay on the team. The specific rule they've broken is about the minimum market value of their publicly held shares. Think of this as the total price of all the company S shares that are actually available for anyone to buy on the open market. Nasdaq requires this to be at least $15 million. For the last 30 days straight, zSpace's market value has been below that mark. Now, it is not an immediate disaster. They've been given a grace period until March of 2026 to fix this. To get back on track, their market value needs to stay at or above $15 million for at least 10 consecutive business days. Their common stock, ticker symbol zSPC, trades on the Nasdaq Global Market. This whole situation with the market value is a pretty direct reflection of how investors are feeling about the company's worth right now. When the market value of shares drops below this threshold, it suggests that either the share price is too low or there aren't enough shares being traded by the public. zSpace says they are actively looking at their options. One possibility they are considering, and this is a pretty big one, is moving their stock listing from the Nasdaq Global Market to the Nasdaq Capital Market. The capital market is generally for smaller companies. It is often seen as a step down, a less prestigious market, but it has lower initial listing standards. It is kind of like moving from the top tier league to a slightly lower one to get your footing back. The company is also making forward-looking statements, which is a standard part of these filings. They're basically saying they intend to monitor their market value and pursue options to regain compliance. But, and this is a big but, they also caution that there is no guarantee they will succeed. They mention that factors like not meeting Nasdaq rules in the future or not getting any relief from Nasdaq could impact them. This is pretty standard legal language, but it underscores the uncertainty they are facing. This report is officially signed on the 3rd of October 2025 by Eric de Oliveira, the Chief Financial Officer. So what does this all mean for zSpace Incorporated? They a technology company, and on the surface it seems they struggling with investor perception, reflected in their falling market value. This is directly about their day. 2. Day business operations, like how many products they sell or how much revenue they make, but it is a critical public signal. Nasdaq's listing rules are in place to ensure that listed companies have a certain level of financial stability and public float. The fact that they are considering a move to the Nasdaq Capital Market suggests they might not have a clear path to immediately boosting their market value back above $15 million through organic growth or other immediate strategies. It's a sign of pressure. While the company is making a commitment to try and fix this, the language used, especially in the forward-looking statements, is quite cautious. They are setting expectations low, acknowledging the significant risks. Looking at it from a Warren Buffett-style perspective, you want to invest in companies with strong and sustainable businesses. While we don't have detailed financial tables in this specific filing, this notice from Nasdaq is a red flag. It indicates that the market, for whatever reason, is not valuing zSpace as publicly traded stock highly enough to meet a fundamental listing requirement. This could be due to a variety of factors, including concerns about future growth, competitive pressures in their industry, or perhaps broader economic conditions impacting technology stocks. The key takeaway here is that zSpace is in a precarious position with its stock listing. While they have time to recover, the need to do so by improving their market value means they need to convince investors that the company has a bright future. Their current strategy seems to be focused on compliance, potentially by moving to a market with lower requirements, rather than a dramatic turnaround in business performance. It will be crucial to watch if they can regain compliance, or if this is a step toward a more significant challenge for the company. Alright, that is our breakdown of zSpace's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.